Futures trading involves substantial risk of loss and may not be suitable for all investors.
Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the suburbs of Chicago. Today is Monday, October 13th, and we have got gold and silver continuing to rip to the upside on the historic bull market run. A continuation of that, with gold making new contract highs, new all-time highs out above $4,100, and silver finally getting out above that technically and psychologically significant $50 level, which takes out the old highs from 2011. So some of these markets starting to go parabolic. If you're looking for more information on that, our branch office down in Florida, Chief Market Strategist Phil Strebel puts out a great video each and every morning, as well as written commentary on the metals. If you have not been getting that, I encourage you to head over to bluelinefutures.com. From there, you can select the market research tab, select the markets that interest you. I highly recommend signing up for that metal content, as well as some of the other agricultural markets, precious metals, energies, indices, etc. You name it. We've got a great team in-house that puts a lot of great information together each and every day. Now that we got that plug out of the way, we can go ahead and jump over to what went on in the grain markets to start the week. And for corn, it was a continuation. That seems to be a theme, a continuation of metals higher. For corn, unfortunately, that was a continuation of lower prices. And that really comes on the back of last week's weakness and failure at the 20 and 100-day moving averages, which are this blue and purple line. We talked about that in length last week, 421, 424 area being the line in the sand that the bulls really want to get out above to encourage additional upward momentum. A failure there put prices back below the 50-day moving average into the weekend, which again put pressure on prices to start this week's trade. Not only that, but really we're starting to mark lower highs and potentially lower lows. The lower low, October 1st, that is 410.5. That happened to be today's low as well. If we break and close below there, your next line in the sand comes in closer to 401 to 402, which is the lower end of the range from the middle to back half of August. So that's what we're looking at there. For the bulls to really regain momentum and footing in this market, we want to see consecutive closes back above the 50-day moving average. So that kind of pivot pocket that we're looking at, 414 to 415, until the bulls are able to see consecutive closes out above there. The bears do have a technical advantage here to start this week's trade. Now over in soybeans, obviously they got whacked on Friday with regards to the trade headlines or lack of trade headlines, positive momentum there in the headlines with China. The fact that we were able to trade in positive territory, I think, is a silver lining for the market, but the bulls still have some work to be done and really want to see some progress being made on those trade talks with China. And right now it seems like we're back to square one. There is no progress and no meaningful new news on that front. So we're back to this 10-10 area, which is where we spent about a week and a half or so in the back half of September trading. That seems to be a point of control for the market. Failure here, and $10 psychologically and technically significant. You also have some trend line support coming in near that 985 level. If we fail at that psychologically significant $10 level, you're looking at a continued pressure towards 985 and 990. So that's what we're looking at in the soybean market. Then for the cattle complex, we got a big move higher, new contract highs in that market as well. So a continuation, that's again the theme of the Monday's trade. Continuation higher in live cattle puts us at new contract highs, which is basically in uncharted territory, which makes it really tough to find meaningful technical resistance points. This is a momentum trade now, so it'll be interesting to see if this market can continue higher. I would say there's a lot of green lights out there despite what you may think of this market. Feeder cattle continue to be a different animal. The average trading range in that over the last 2 weeks is right around $6.25. So that's become more of a spectator's game, especially for speculators who are trying to day trade or swing trade these markets. A feeder cattle contract, the notional value just so much bigger than what we're used to. So a lot of people just kind of putting that on the back burner and focusing on some markets that maybe have a little bit more control intraday in terms of trading ranges. And lastly, we will touch on the lean hogs. A big breakdown last week, but we kind of gravitated back towards that 100-day moving average and trend line support there near 84.5, 85. We wouldn't be surprised to see the market maybe see additional relief towards that 50-day moving average, which comes in near 86.25, so long as this 100-day and trendline support can show signs of stabilizing the market here to start this week's trade. A failure and break close below Friday's low near 83.75. That opens the door for continued downside pressure. But for now, I wouldn't be surprised to see this market maybe attempt to consolidate and work back a little bit higher before figuring out what it wants to do next. So that's what we're looking at. If you've got any questions at all, don't hesitate to reach out. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.